Okay, so I mentioned before the break that I had picked a company for each of you. I'll give you a little bit of background of how I picked these companies. First is I look at where you work and what, both in terms of region, and I try not to pick the company. In fact, I don't pick the company you work for. You know why? Part of this exercise is for you to look at a company and say, the CEO of this company is an absolute fool. And that's going to be tough to do if you work for the company. It's going to be even tougher if you are the CEO of the company. Okay? So it's good to have some distance. It's easier to have some distance if it's not your company. So for the most part, it's not the company you work for. I try to find something in the same space, in the same region, which doesn't always work, because some of you work for nonprofits and there's no clear. I fought the urge to give you perverse choices, like if you're a green, giving you Monsanto to analyze. I thought that might freak you out. So I tried as best as I could to find a company that fit you. There are too many Russians in this class, to be quite honest. And the problem is, the number of Russians in the class exceeds the number of Russian companies I can come up with that are interesting companies that are not basket case oil companies. And only so many times you can give Gazprom before people say, this is a disaster waiting to happen, I'm not touching it. So I had to kind of wander away from regional preferences if you had too many people from one part of the world. And I'll tell you the other thing. The packet you have is printed off a Bloomberg terminal, which means you need access to a terminal. There are Bloomberg terminals around the world. That's how Bloomberg gets rich. I think it charges like $100,000 a terminal. So it's not some. So don't go home and say, I'm going to order a Bloomberg terminal for my house. Unless you're really wealthy, it's not a good idea. Now that's $100,000 a year. In case you think, oh, one-time cost, not a big deal. So this is a Bloomberg packet that I printed off for your company. It's about, let's see, 2, 7, 8, 9, 10 pages for most of you, 9 for some of you. You also should have got a second packet. I don't know whether you've got it yet, but you will soon, on how to read this. Basically, it shows you where to find items. You don't need it for the moment. Just keep it aside. If you say, where would I find net income in this 9 pages, it'll tell you where to go look for it. Okay? So the reason I printed up this Bloomberg packet is at the end of this class, you'd have analyzed one company, a very specific company. It might be a declining, growing, young company. And you will learn something about the company. And maybe some of you will say, I really want to get this corporate finance thing nailed down. You know what you need to do? Don't take more. You're done. After these 3 days, corporate finance is not rocket science. There's no theory to get beyond it. If you want to master corporate finance, pick another company. If you can get to a Bloomberg, you can print off the same 9 pages for any company, any of the 41,890 companies around the world. You can print this page off and do the second company. Then do a third one. I do this in both my valuation and my corporate finance classes. I say, neither is a science. You know what the essence of a science is, right? The laws are immutable. You're the CEO of a company, you get the janitor next to you, you jump out of the 15th floor of your building. You can say, I'm the CEO, slow down, I'm not hitting the ground. You're going to hit the ground the same. It's the laws of physics apply to everybody. That's the essence of a science. Neither valuation nor corporate finance is a science. Neither is an art. You know what the essence of an art is? You can do whatever you want. You can't do that either. I describe both as crafts. In fact, I'll give you the analogy I offer. Cooking is a craft. How do you learn cooking? Reading cookbooks? Watching cooking shows? No, to learn cooking, you got to go into that room in your house that's called the kitchen. Remember that room? You got to walk towards a thing called a stove. You got to turn it on, put a skillet on, and start cooking. The first time you cook, it's going to taste like crap. Even scrambled eggs won't look like scrambled eggs, taste like scrambled eggs. But you learn by doing. The same thing applies in corporate finance. So if you want a pathway to get from this to mastery, it's actually in your hands. Basically, it's picking companies and analyzing them. I mean, I probably analyze a company every week. And I've been doing it for 30 years, and I still learn every time I pick a company and take it apart. Something about corporate finance I hadn't thought about. So that's what you're going to be doing, is your company is going to run through the rest of this class as your lab experiment. Okay? So let's go back to that objective in corporate finance. The objective I said was to maximize the value of the business. Let me kind of zero in on that objective and talk a little bit about why we picked that objective and how it gets narrowed in practice. To understand what this objective is all about, I'm going to go back to that financial balance sheet I showed you earlier. Right? Assets in place and growth assets, debt and equity. The objective in corporate finance is to maximize the value of your assets, both growth assets. So if I hire you as CEO of Snapchat, I want you to be thinking about growth assets constantly because that's where your value comes from. And if I hire you as CEO of Microsoft, I want you to preserve the value of your assets in place because that's where the bulk of your value comes from, maximizing the value of your assets. But here's the catch. I'm the manager of a publicly traded company. You guys are stockholders. You guys are bankers and bondholders. I still get capital from both of you, right? The debt and equity. Now, who do I answer to as a manager? The board. And the board, at least in theory, is supposed to, and we'll talk about how that's supposed to kind of falls apart, but it's supposed to stay. So, in theory, I really don't care about the bank and the bondholders. They said they have an interest, I have to make the interest payments, but my primary constituency is stockholders. So in practice, rather than focus on the entire firm, I focus on just the equity in the firm. So you can already see the narrowing from maximizing the value of the business to maximizing value of equity. And at the end of every year, what are you going to do as stockholders? You're going to see whether I created value for you, right? And if you're a publicly traded firm, what's a lazy way of checking to see whether I created value? I look at the share price. So in practice, what happens in corporate finance is rather than maximizing value, I maximize stockholder wealth. And rather than maximizing wealth, I maximize stock prices. Many corporate finance textbooks, you'll be told the objective in corporate finance is to maximize stock prices. That's not true. That's a narrowed, condensed version of it. And I want to start with that objective. You can see why people do it. It's easy. It's right there. Let's just think. So the way this plays out is the company says, if I do the right thing, my stock price should go up. I'm going to start off by listing the assumptions you need to make for stock prices to be a stand-in for stockholder wealth, and stockholder wealth to be a stand-in for maximizing value. And along the way, we're going to talk about all the perverse things you can do as a manager to do what? Push up your stock prices while destroying value, right? So we'll talk about that because that's where the weakest link comes in with stock prices. So let's start with classical corporate finance. In classical corporate finance, all companies need to do is focus on maximizing stock prices. Here are the assumptions I need for that to be the only objective function that a CEO has to have. I'm going to call this the utopian world from which corporate finance is born. And already by calling it utopian, what am I telling you about the assumptions I'm going to list? What's the definition of utopia? It never existed. So the assumptions I'm going to list are going to be blatantly unrealistic, but I want you to kind of hang in there. So think of this as this classical world. So here are the 4 assumptions I need for maximizing stock prices to be the only objective you need as a CEO. First, I have to assume that stockholders have complete power over managers. They hire and fire managers. How do they do it? Through the annual meeting, through the board of directors. Totally blatantly unrealistic. And managers are so terrified of what stockholders will do to them, they go out and maximize stock prices. Second, I'm going to assume that bankers and bondholders lend money to the company, and even if they don't protect themselves, they leave loopholes the size of a Mack truck, the company doesn't take advantage of them. Why? They worry about reputation effects, having to go back to the bank. I could give you a plausible story with each one, but clearly unrealistic again. Third, I'm going to assume that if you as the managers find out something bad is happening in your business, you run out to markets and reveal that information honestly and on time. And on time, right away. So let me give you an analogy. I've been an Apple user for 30-something years. And for a long time, Apple did not come out with a laptop. In fact, I think it was the early 90s, they came out with their first laptop, very loosely a laptop because it weighed like 15 pounds. It's a PowerBook. We're happy. Finally, we have our own laptop. It had one small problem. It sometimes caught fire. It had this battery from Sony that heated up to the point of combustion. Now, this is not normally a feature you go looking for in a laptop, right? Spontaneous combustion, not on that one, not, oh, that one has it. Okay? It'll make your next presentation incredibly memorable, but your next plane trip could be a disaster. Now, the world that I described, what did Apple do the minute they found out about these laptops catching fire? They'd run to markets and say, our laptops are hot. And that actually should give you some insight into how companies lie. It's errors of omission. With 4 kids, I can attest to this fact. It's not errors of commission, but errors of omission, the things you forgot to mention to me. So when you hear laptops are hot, as stockholders, what do you think? Oh, they're selling you don't think of laptops are hot as going up in flames. So let me take this back. In the world that I described, Apple would run out to the market and say, our laptops are catching fire, guys, we don't know why. It's like when Apple Maps first came out, remember all those horror stories? This woman would get in to drive to the local Dunkin' Donuts 3,255 miles later. It was doing strange things like taking you across the country. And first, if you're stupid enough to follow your maps for 3,255 miles to get to a Dunkin' Donuts, you probably deserve what you got. But in the world that I described, companies would be very forthcoming about bad things happening. And when that information hits the market, I'm going to assume that investors are going to be rational and cool about the way they assess the information. You know what a trading room would look like in the world that I've described? It'd be filled with polite intellectuals. It's kind of a typical trading room, right? So the news comes out, they get together, they have this long discussion about the effect on value, and then they trade. Completely unrealistic. But it's my world, utopian world. I can create it any way I want. And in this world, there are no social costs. What are social costs? It's not just that it's an environmental cost. If it's an environmental cost that I can trace to you and charge to you, it becomes an economic cost, right? So the essence of a social cost is the cost you create for society that cannot be traced back to you. And already you're saying bad companies create social costs. Good companies don't. Is that true? No. Every business creates social costs. Remember that hot dog stand outside that I talked about? That guy creates social costs. You know what it is? Every morning when I walk down that sidewalk, he's right in the middle of the sidewalk. I have to walk 3 steps to the left, 5 steps around. It's like 15 additional steps because that guy's there. Multiply that by the number of people walking down the sidewalk. That's a social cost. All businesses, by their very existence, create social costs. So what am I doing? I'm doing what the classic economist does, which is when you have a problem, what do? You assume it away. So there are no social costs. You're saying, why do you need this world? What am I trying to do? I'm trying to make the world safe for maximizing stock prices, right? I'm trying to take away all the bad ways in which you could maximize stock prices. Like what? You could rip off the bondholders. That could, so in a sense, if they left loopholes, you could transfer money from the bankers to your stockholders, take advantage of loopholes. That would increase your stock price, but it's not increasing your value. I'm saying you can't do that. You could increase your stock price by lying to financial markets. I'm saying you can't do that. You could increase your stock price by doing horrendous things to society. And I'm saying you can't do that. So it's the only way you can increase stock prices in this world. You've got to do it the old-fashioned way. You've got to go out and find business opportunities, invest in them, and actually make money. That's so much work. But in a sense, that's where I'm forcing you. In this world, all that matters is maximizing stock prices. So file that away. Yes?
Sorry. What you are saying is very, very clear. Does it apply to the B corporation as well? And do you have any opinion about it?
Does everybody know what a B corporation is? B corporations are these benefit corporations that have been created. There's this clause in the corporate charter that allows these companies, like ST. ST is a B corporation. I think it's a fraud, to be quite honest. I think it's a fraud not because the people who created these companies are not well-intentioned. But what did I say? You cannot serve 2 masters at the same time. And what I find in B corporations, and you can take the history of ST and start to see how this plays out.
This is exactly the reason of my question. Yeah. Because at the moment, the European Parliament is considering a specific legislation on B Corp, and specific countries are doing B Corp. B Corp means, as you said, social impact and profit.
This is why Parliament should have no role to play. Right. In this game, because what they will do is screw this up big time, and guess what? They will have another legislation to fix the problems they fixed with this one, and it'll be the string of bad legislation on top of each other. It's not that I don't think society doesn't matter, but I think what happens to these B corporations is you give them an escape hatch. So when they don't do well financially, you know what they say? It's because I was working for society. Then if they do bad things to society, you know what they say? Well, I have an obligation. So in a sense, what they do, this is why stakeholder wealth maximization. It's nonsense. Do I care about stakeholders? Of course. Do I want my customers to be happy? Yes. Why do I want them to be happy? Because I want them to keep buying. It's a purely must. It's not happiness somehow pays off as a return. Do I want my employees to be happy? Yes, I want them to be happy to work because then they don't leave my company and go work for somebody else. We cannot, I think what this does is it brings constraints and makes them objectives. Do I want my companies to be socially responsible? Absolutely. It's a constraint that I'm going to put on their objective. But it can't be an objective because in a sense, if I let them have 5 objectives, it becomes a blame the other stakeholder group for everything that goes wrong. So I think B Corps are well-intentioned, but I think they're driven by 2 things. One is owners who want to keep control. That's one thing, which is this allows them to do whatever they want and not be accountable. In fact, there were a case of a company got targeted in a takeover, decides to reincorporate in the Netherlands, and I'll get the name of the company later today, to try to avoid the takeover. So it's a purely mercenary reason, but they framed it as, we're doing this because we're a socially responsible company, when the reality is we were protecting the jobs of the managers of the target company. So it's actually a very interesting and perhaps insidious development where companies try to have their cake and eat it too. Okay? So we'll come back and talk about specifically how do you take care of society in a world where businesses go out and try to maximize value. That's a legitimate question that we need to ask. But I think the B Corp is not the solution to that problem. Okay? So that's the classical world. Do you live in that world? Where managers reveal information honestly and this isn't the world we live in. So let's make this real. Okay? In fact, let's think about what can go wrong. And the real question is not what can go wrong, but what cannot go wrong. Because every single link is potentially a problem. Let's start with the first one. In a typical publicly traded company, stockholders have little power over managers. And that's true even in the US. There might be exceptional cases where stockholders, but in a typical publicly traded company, stockholders have little power. And here's why. What are the 2 mechanisms I said you have to exercise power over managers? The annual meeting and the board of directors. Let's start with the first one. How many of you own shares in publicly traded companies? Okay, it's quite a few hands. Masters in my MBA class, nobody does because you're out of wealth, you can't invest. So it's kind of an early stage in the process. Now let me ask you a second question. How many of you have been to an annual meeting? To an annual meeting. You know how corporate meetings, they have an annual. That's not bad actually for. I've never been to an annual meeting. I own shares in about 53 companies right now. Never been to an annual meeting. You're saying how irresponsible of you. I'll tell you why. I own shares in Coca-Cola. What does it mean for me to go to an annual meeting? I have to fly to Atlanta. That's going to cost me like $500 round trip. I have to stay in a hotel in downtown Atlanta. That's like hell on wheels. You've been downtown Atlanta. The whole city empties out at like 7 o'clock. That's going to cost me another $500. So I'll end up paying $1,000. By the time I'm done, there goes my profit for the year. So for me, it doesn't make sense to go to an annual meeting because economically, it's just too costly. So what do I get about 6 weeks before the meeting that lets me be at the meeting in absentia? A proxy. It used to be a fat envelope. And when I get it, I'll make a confession. It goes in one of 2 places. If I'm feeling socially conscious, it goes into recycling. If not, it goes in the trash. So that's the only question I ask. I'm not opening that up, going through 40 pages, voting for people I don't know. And I'm not the only one. You know that more than 50% of proxies never get returned? So when I own 1,000 shares in Coca-Cola, so when I threw that proxy into the trash, it's 1,000 votes that should go with it, right? But in most companies, when I throw that proxy in the trash, what happens with 1,000 votes?
To the management.
It goes to the management. I'll give you the analogy. This is like having an election where the incumbent gets the votes of anybody who doesn't show up to vote. In the US, no incumbent would ever get defeated. I think the total turnout last election was 49%. You wouldn't even have to vote for yourself. You've already won the election. 51%, I'm already home. You can already see it's a process. That's why it's so difficult to get a no vote against incumbent managers at an annual meeting. Remember Jamie Dimon had this issue with JP Morgan stockholders? I don't know if you remember, about 2 years ago. Jamie Dimon, who's a little bit of a dictator, actually, a lot of dictator in him, decided to consolidate the chairman and the CEO positions and hold both. And of course, there was this pushback from stockholders saying this goes against corporate governance. You can't oversee yourself. And it came up to an annual meeting vote. And the final vote was that 63% said yes, he can be CEO and chairman, and 37% said no. Decisive win, right? But think about it. What did I say? More than 50% of the votes don't get returned. You start. So when you win 63-37, you're actually being outvoted 4-1. So next time you see a 35% no vote in an annual meeting, that basically means that anybody who bothered to vote voted against you. But it's very tough. We'll talk about how you might be able to tip the scale sometimes in some companies, but it's very difficult to get managers to change at an annual meeting. And if you think it's bad in the US, it gets exceptionally difficult in the rest of the world. European annual meetings are exquisitely polite affairs. That's not a compliment. They drink a little wine and they do a little stuff. And if you ask tough questions of managers, you're viewed as this uncouth barbarian. You can't do that of managers. What's wrong with you? Where did you learn your manners? You Anglo-Saxon. So it becomes so I can understand that politeness matters, but not in an annual meeting. You want annual meetings to be get down and dirty affairs where people ask tough questions because that's what it's supposed to be, but it isn't. The annual meeting doesn't work that well. So you're saying, what about the board of directors? If you go back and look at corporate law, you know why board of directors was created at a publicly traded company? What's the job of a board of directors? It's to protect the interests of the stockholders because you have a separation, right? So board of directors' job is to put managers on their toes and say, you have to do the right thing. In most companies, though, you know what happens to the board of directors? They become defenders. They view their job as defending managers against stockholders. So how does that happen? Well, I told you I was going to use 6 companies in my lab experiment. Let me get started. I'm going to start off with Disney in 1997, way back in time. But I'm going to go back to 1997 because I'm convinced that this is the worst board created at a large US company ever. That's quite a competition to win, right? Worse than the Enron board? Yes. Worse than the ADM board? Yes. So let's see what makes this board so bad. First, in 1997, you know who the CEO of Disney was? A guy called Michael Eisner, a guy whose ego was so big that he could be in a room alone and feel crowded. This was the board he put together. Keyword is he put together. You're saying, but we get to vote. If you work in a company, in a publicly traded company, here's my challenge to you. Open up the annual report, go to that page where they list out the board of directors, ask yourself, who comes up with these names? Do they go to the phone book and alphabetically just pull people out randomly? In most companies, how do they come up with these names for people to serve on the board? Well, there's a nominating committee in some countries, but the reality is the CEO. So let me ask you a question. If you're the CEO of a company and you're looking for a board, and you have 2 choices. One is you can pick the 15 most intelligent, informed people in the world who will ask you tough questions and keep you on your toes. That's option 1. Or you walk over to the local country club, walk into the bar area, find the 15 most sloshed people you can find. Say, would you like to be on my board? Ask yourself what's going to make your life easier. Look at those sloshed people. You feed them martinis through a meeting. They have no idea that you're investing in China and losing. They say, I don't care, bring me another martini. If you're thinking as a CEO, what makes your life easier? It's easy to have a rubber stamp board. This is Michael Eisner's board. So let's start off with what I dislike about the board. First, there are 17 people on the board. Say, so what? Run this experiment. At the end of class today, you're going to be exhausted. Try to get together as a group of 17 and try to decide where to go for dinner. I'll make a safe prediction. You will not eat tonight. Have you ever been in a meeting of 17? Nothing happens. So my first strike against the board is there are too many people. In fact, studies show that once you get past 9 members on a board, it starts to get too large. That's In fact, 9 is perhaps the optimal number. 17 is way too big. That's the first problem. Second, 8 of these 17 members on this board are insiders. Insiders in what sense? They either work for Disney or continue to work for Disney right now. What's the job of this board? To make sure the people who are running Disney are doing the right job, and half the board is people running Disney. Strike 2. Who's the chairman of the board? Michael Eisner, chairman and CEO. This is a practice that I cannot find a good I can't even find a reason that I can give for why this is an okay practice. How do you get away with this? You're going to chair the board that oversees you, and you're going to tell me whether you do a good job. What am I going to find? Of course you're going to find a good job. You're doing a good job. Chairman and CEO. Now, if this were baseball, you just struck out. But this is such a bad board, I'm going to keep going. Let's look at the outsiders. Maybe they're so good they make up for all this crap. Let's go down to this. Rebecca F. Bowers, principal of an elementary school in LA. You're saying this is good. Disney is a kid-oriented company. She works with kids all the time. Perfect. Coincidentally, otherwise, she happened to be the principal of the elementary school that Michael Eisner's kids went to. I'm sure it's pure coincidence. Let's keep going. Right? George Mitchell. He's checking for steroids on the board. That's an inside baseball joke if you had no idea. Father Leo O'Donovan, president of Georgetown University. He's saying this is good to have some religious influence on this heathen board. Again, coincidentally or otherwise, Michael Eisner's son went to Georgetown. He sat on Georgetown's board. He'd made substantial contributions to Georgetown. Not saying there's any quid quo pro, but it doesn't strike me as passing the smell test. But here's the most egregious example of conflict. See this guy, Irwin E. Russell, attorney at law? He's saying, what do you have against lawyers? Actually, plenty. But this is not the forum for me to talk about that. Okay? But this guy happened to be Michael Eisner's personal attorney. How do you get away with this? You're putting your lawyer on the board, say, trust me, he's going to be an objective third person. Really? It's nice to have your lawyer in the room saying, don't answer that question, Mike. Take the fifth on that one, Mike. But don't tell me he's going to be an objective
Do you have
director.
something against lawyers? No.
I have lots against lawyers, a whole layer of things. Are you a lawyer?
For sure.
Okay.
Because
Then I'll watch out for you.
his duty to the corporation, it's a conflict of interest. His duty to his client and his duty to the corporation.
Absolutely.
How could he even get to sit there?
That's my question. That's my question.
It's
How do you get?
unethical.
But take a look at a lot of boards. You'll be amazed at how many lines get crossed in boards, right?
And nobody's going to
The
take
Bar
it to the bar.
Association has anything to say about that?
The Bar Association, this is not unethical from a legal perspective. It's unethical from a corporate governance perspective. It's a very different problem. You can put whatever you want. So the problem here is a corporate governance layer. You're not in a courtroom, right?
Who makes the call on that then?
Who makes a call on that? The CEO did. The question is, will the stockholders make? No, because ultimately the stockholders vote for it. I'll talk a little bit about the legal changes that came about because in 2002 Sarbanes-Oxley came about in response to a crisis. Every legal solution to a corporate governance problem creates more problems. Okay? It's like passing a law that says from tomorrow we're going to have a good democracy. You pass the law, right? What does that mean? Only well-informed voters will be allowed to vote. Oh, that's nice. Let's pass that law. It's easy to pass laws that fix corporate governance. But ultimately, if you want a good democracy, what has to happen?
The person running the democracy has to be.
That's almost an oxymoron. You can't have a person running the democracy. It's a democracy. Right? What's the essence of a democracy? Who are the persons who run the democracy? We. As long as we as stockholders let this happen, it is going to continue happening. So that's going to, in fact, that's going to be my bottom line, is we have to wake up to corporate governance. As long as because it's human nature. It's not because Michael Eisner is a bad guy. He's going to make life easy for himself unless I push back. In 97, there's very little pushback.
But I have a question. Where's the auditor in all of
Auditors have nothing to do with corporate governance. Auditors' job are your accounting statements. So auditors can't do corporate governance.
this?
That's
If
not
you
the...
were press, they would
No, because that's, in a sense, all an auditor's job is, and it's not fair to ask auditors to do more. If you ask Price Waterhouse to come in and say, is the corporate governance in this company right? You're asking them to do things that they're not equipped to do. All they can do is check debits and credits, Make sure you're reporting in your balance sheet. They can't even stop you from taking bad projects. That's not their job. It's to make sure that if you take bad projects, you tell the world you took bad projects. That's all auditors can do, is make sure the information you disclose reflects what's happening in your books. So there is no solution from, I think what you're looking for is a solution from above. And I'm afraid the solution has to come from below, which is a lot more work, right?
But when you have today with the ETFs and people investing in indexes, they don't even have direct access to the...
You don't need a lot of people to be active, and that's going to be the other message. You don't need 95% of the people to be active. You often need 3 people to be active. And I'm going to come back and give you my defense for activist investors who have acquired a bad name. Let's face it, activist investors are not nice people. I don't want to have dinner with Carl Icahn. I'm afraid he'd eat me. But I need Carl Icahn out there. I describe laxative, and this is going to strike some of you as gross. They're like laxatives. I told you it'd be gross. What's the job of laxative? It's to irritate your bowels to create movement. And I'll let you kind of fill in the detail. That's what activists do. They're not nice people. They irritate the system. They're going to say things you don't like. They're going to get in managers' faces. They're not pleasant people, but you need that as almost what keeps the system going. Because the reality is, with 1,000 shares, I could get up on rooftops and yell about how much I dislike what Coca-Cola is doing. You know what they're going to say? Crazy guy on the rooftop. I don't care what he say. Right? So in a sense, that's why markets have to open up. But the reality is, the pushback you get is, they're bad people, they will ruin companies. So we'll come back and address that more specifically. But I think in a sense, that's my case for corporate governance, is you need people pushing against. Yes, question?
I agree with Tiago. I think at the moment it's very, very important to understand the shareholder impact. And now shareholders are very, very diversified. They own shares in different ways.
Yeah.
So the issue probably, and we need to rely on very friendly people.
First, let's say,
Right.
who's we here?
Shareholders.
Okay, so
Stakeholders.
you're talking as a shareholder in the company.
Yes.
Because the first thing
Yes.
is, if you're not a shareholder, you have no business even poking your nose and telling people how to. So if you're a shareholder,
Yeah.
now let's talk. Okay, go ahead.
So the point is this, that you in Coca-Cola, me in Google, our voice is too little.
Right.
So we need to change the way how we understand boards and probably try to fix technicalities in the board. So headhunters can choose.
See,
the
I
board.
think that's a wrong path to go, and here's why. That's a rule-bound solution to corporate governance. That's what Sarbanes-Oxley is, right? It says, these are the kinds of people who can sit on your board. These are the things that you need to create an independent board. And that's what
Right.
corporate governance law has become, is how do you create more independent
Right.
boards?
Right.
It's not asking how do you create more effective boards. It's easy to create independent boards, but it's what's an effective board? It actually pushes back. So when people say, I've got the high corporate governance score, you know what the question I ask them is? Show me something you've
Professor,
done. Yeah.
sorry if I interrupt you. In the real world, shareholders, they choose the CEO and they choose the board.
No, they don't choose the CEO. They choose the board picks the CEO.
Yeah.
You have, CEOs are not elected, right? So the board picks the CEO, so you vote on the board. And that goes back to the point. As long as we let this process, and you know what, who I blame? It's the big institutional investors. You know that institutional investors vote with management 93% of the time. Fidelity, State Street. Why? A, because it's the easy path. B, because they have other logs in the fire. Conflicts of interest. Things that they don't want to push back. I listen to this guy, Larry Fink, who runs BlackRock. The guy is in a... I listen to the guy and say, how can somebody like this run the largest money management company in the world? The guy is an absolute dunce. And I'll say this, I'm on camera, so the guy is an absolute dunce. Pass the message on. You know why I said it? Because he said the problem with markets is we have activists. I said, okay, let's take the activists out. What have we left with? BlackRock and Fidelity and State Street. What are you going to do? Vote with management all the time. And then where are we? So I think that we'll come back to this issue over and over again. But the reality is, look at this board. This is not a board designed to be a check on the management. This is a rubber stamp. In fact, I forgot one final name, Sidney Poitier. Great actor, right? In fact, he made the list of top 10 directors in 97. He's saying, finally, somebody who made the top 10 list. This was the wrong list. In the list of directors who missed the most meetings, Sidney Poitier was up there. So guess who's not coming to dinner is, hey, guess who's not coming to the meeting this time? You have no idea what I'm talking about. That's Sidney Poitier's most famous movie. So he's saying, so what if the board has no power? If the board has no power, what's the CEO going to do? Whatever is. Will that be good? Yeah, it could be. In fact, Michael Eisner ran the company really well from 86 through 94, 95. Remember the old thing about benign dictators versus, is it better to be a democracy or a benign dictatorship? Well, people have a tough time choosing. Because what if Lee Kuan Yew was my, that's so the Singapore model. I'd rather have that than the chaos that I have. Now, what's the problem with that, going down that path, though? In fact, most benign dictators at some point in time become malignant. And that's the reason you need a check. As CEOs left to their own devices, their head gets bigger and bigger, and at some point you cross that line. Now, in fact, you're going to see this. It's not Michael Eisner specifically. Any CEO who stays on long enough will accumulate the trappings of power. Will get a board that ends up becoming a rubber stamp board. Yes?
Just to build on that, I have a benign dictator who runs my company, who came in to speak to us last week, Martin Sorrell.
Mm-hmm.
And he's a brilliant leader and has
Right.
delivered incredible value for the
Right.
business. But our big problem is he's 74. So what happens next? That's the other big problem.
That's the other thing is, so I think that's part of what you want, is you want pushback. Because if you're really good managers, you know what? With pushback, it doesn't mean they're going to get stopped. They will have to explain what they do along the way, right?
Leave a legacy that someone can...
And that might give them a framework for somebody else to pick up.
Wouldn't a great CEO want such a board that pushes back? Because it makes him most successful in the long term.
You know what? Human nature is such that even if you're great, and this is part of the problem, is that the longer you're treated as a great CEO, people keep telling you you're great. After a while, you get that imperial
So
complex.
everybody breaks.
That's my view. Maybe I'm cynical, but if you treat person as great continuously, at some point in time, they start buying into their own house. Right? And once that happens, I think it's, you can say, why can't you become more spiritual? The reality is spirituality goes to the backside once you become viewed as the leader. Yes?
Just to add to that, the problem we have as directors and chief executives in the public market are that all shareholders have different duration in terms of investment duration.
It could be, yeah. And in fact, that could...
Which means you're trying to serve many masters at once.
But I think that if it's a shareholders who have whatever time horizon you're serving them, you can say they're the owners. So if you're, let's say, owner, the simplest way of dealing with this is to think of being an owner of a private business. Right? I hire you as a manager. I come in tomorrow and say, how did my business do? And they say, well, I've been giving away stuff. He said, what do you mean you've been giving away stuff? He said, well, I have a really long time horizon. I think this is going to work out. You know what I'm going to do to you? I'm going to fire you because it's not your business. But in companies, we let managers tell us, hey, it's your money, but I'm going to tell you what the right thing to do for your money is. And it's an issue. We'll come back to this time horizon issue. I think it's an issue because I think the bigger problem is, what if you have millions of shareholders who diverge on time horizons? Whose time horizon should you make your decisions on? I'm going to come back with a notion of a marginal investor. And it's not going to quite answer your question, but I think you have to run the company as if it's their company. I'm saying you as a manager.
I would disagree.
Yeah.
And the reason I would disagree is because consensus when it's wrong is a disaster.
But it's their disaster. I think that in a sense you cannot put on the hat of being the all-knowing, I'm going to fix this. It's somebody else's business.
It links to your point about the fact that more than 50% of people don't vote. Therefore, they've subcontracted the management of the company, and the explicit statement is that...
But I think then you have the job of presenting your vision and getting me to buy into your vision. So that's what Jeff Bezos did, right? So if you can do that, then we're not disagreeing. I'm saying, okay, you have a vision that's different than what other people see for your company. You're the CEO. Get that vision out and get people to buy into that vision. You have to have a narrative that people buy into. You can't just say, look, this is my vision, I'm running the company, I'm going to impose my vision on you. That, I think, is a problem. So I have no problem with you as a CEO saying, hey, everybody here is wrong. I think this is the pathway for the company, but then the next step is you have to sell me on that pathway. Get me on that.
Well, that implicitly happens in public markets because we have quarterly reporting, we have investor relations, we have investment analysts. So
No, that's not where it's going to happen. Vision doesn't show up in quarterly reports.
It does. You can read statements.
No, that's me. Let's face it. What you see in quarterly reports is not vision. It's stage management. Vision with Amazon, the vision has always been from outside the statements. What Jeff Bezos has said about the company is essentially been. It might show up in quarterly reports as numbers in terms of how he acts, but the vision came from outside. So I'm not saying those quarterly statements will.
That's an exception to
Right.
Okay, but let's take Goldman Sachs.
Yeah.
Okay. We get what Harvey says and we get what board says.
Yeah.
As reported this morning, and there will be a statement from the chairman and the chief exec.
But I read that statement. There was nothing in there that tells me about a vision for Goldman Sachs. It just tells me what they see as where they are now. Vision to me is a much bigger thing. It's about the story you're telling about the business and where you see it going. I don't see that in that statement, right?
We said this morning. They talk clearly about the cost of capital. They talk about
That's
regulation.
not vision. That's devices you can talk about along the way. So we'll come back and talk about this because I think we might be talking about the same thing at two different
Well,
levels.
the point I was trying to make
Right.
was that I believe the vision is explicitly announced in quarterly reports and in the reports of accounts.
And why do you think investors don't trust that vision in 95% of companies? Because in 95% of companies, that vision gets ignored.
Well, if they don't, they sell stock.
No, that's not true. They have their own vision that they superimpose on yours. Apple might tell you what their vision for the company is.
Yeah.
Investors have their own vision. So what you have then is all these dozens of visions.
If you don't believe the vision, you sell
No,
stock.
you can have a different vision that's even more optimistic than the vision you might be. So you're assuming that the vision is always going to be more, that the management vision is the optimistic one, the counter vision to the pessimistic ones? No. It's just different people have different stories when they invest in companies.
Hey, John, if you don't like that structure,
You sell
then
the
take
company.
your company private.
No, but if you're a listed
That's the way it
company
works.
Right,
and one of your shareholders has a different vision,
right.
he can sell his stock. Right?
But why does he have to? But what if enough people have a vision that's different from yours? Can I then ask you to leave as a
That's
management
different,
company?
isn't it?
That's there. So individual visions can be different. If you get, that's what I meant about it. If you can sell your vision to 51% of the shareholders, then it's fine. You can run it by that vision. If 2 years later your vision is not working, though, that 51% might become 23%.
But the feedback loop is
That's what the board of directors is there for, is to give you that feedback loop. And the point I'm making is, if you don't have that feedback loop, then you get to 23%, and you're still acting like you have 51% on your side. So, to me, the board of directors is not there to prevent you from having a vision. It's to give you that feedback loop when that vision is starting to fray. And to me, a good board does that. No.
which the share price would tell you to.
Well, the share price might as well, but the share price might not be enough of an indicator for you to listen, right? But to me, so that's why I need a board of directors pushing me to see the failures in my vision, maybe things that are not working. So incidentally, that bad board, you know how it showed up? Is Disney did some really strange things in the 1990s. And you look and say, well, how did they get away with this? I'll give you an example. You know where Michael Eisner came from before he was CEO of Disney, where he worked? He worked at a company called Paramount, movie company. And Disney was in trouble in '86 when they hired Eisner. They hadn't had a hit in a long time. The company had lost its vision. It had really was all over the place. And they hired Eisner. And Eisner, as condition for coming to Disney, said, I'd like to bring my personal assistant with me. Sounds like a big deal, right? But in Hollywood in the 1980s, your personal assistant ran your life. They kept your calendar, they had your contacts, they knew who you were married to, where you lived, etc. So they just checked for you. His personal assistant was a guy called Jeffrey Katzenberg.
Who was Diller's person?
Well, he was, but at that time.
At that time he was running
Yeah.
animation.
But when he came over, he really didn't want to come to Disney. He said, no, that's a loser company. Paramount's doing well. Why would I want to come there? And as part of the quid quo pro for getting him to come over to Disney, Eisner said, I'll give you your own division. The animated movie division. At that point, Disney hadn't produced a hit in, what, 15 years? Fox and the Hounds might have been the last hit. And as part of the deal as well, he said, he was so convinced that this animated movie division was going nowhere, he said, I'll give you 3% of the profits you make on this division. Katzenberg comes over, becomes the head of the division. The rest, as they say, is cultural history, because you have Little Mermaid, The Lion King, a whole series of movies that become hits. And by 92, Disney's animated movie division was producing 30% of Disney's profits. Now, if you hire a guy to run this division that you think is on its end games, and he turns it around, and now accounts for 30% of the profits, in any fair world, what would you do? You'd give him more responsibility, right? But that thought never even crossed Eisner's mind. He said, I've got to get rid of this guy. Why? Because he was afraid that he was being too successful, a threat to the throne. So he went to the board and said, I've got to fire this guy. Now think about it. You're a board of directors. I've asked you to fire the most successful divisional head I had. You'd probably push back, right? But this is the Disney board. They said, how quickly do you? Okay. He said, right away. And one of the directors did bring up this unpleasant fact of, hey, you promised him 5% of the profit. Can you imagine getting 5% of the profits on The Little Mermaid in perpetuity? You'd never have to work a day in your life. And Eisner said, don't pay the guy. He said, what do you mean? You have a contract. He said, don't pay the guy. So what basis? I don't like him. Okay. Disney fired Jeffrey Katzenberg and refused to pay him, and of course he sued. That case didn't last very long. The judge read he said, Mr. Eisner, have you promised Katzenberg? He said, yes. On what basis are you refusing to pay him? Well, I don't like him. I'm sorry. That doesn't pass the legal requirement. You got to pay him. And so Disney had to pay $150 million to Katzenberg to go away. Which he used as seed money for what? DreamWorks. Have you ever watched the Shrek movies? Notice all the digs they get in at Disney characters. Right? Like Sleeping Beauty has an addiction problem, in the movies. Snow White hangs out with 7 perverts, and you say, what the heck is going on here? That's the history of Katzenberg and Disney playing out. Get a chance, go watch all the Shrek movies. Bad boards have bad consequences. In fact, that's one common element you see in every scandalous corporation, right? You go back and dig deep enough. You have a board of directors that's gone to sleep. Gone wild. Wild I would take. Gone to sleep. Right? So neither mechanism, neither the annual meeting nor the board of directors works. So what do managers do? Put their interests over stockholder interests. Nothing again. That's human nature. When managers have to choose, they have to put their... Sometimes the two interests will converge, but it's almost accidental. I'll give you some examples of managerial interest kind of overwhelming stockholder interest. You know when it most manifests itself is when your company becomes a target of a hostile takeover. Kind of forces you to pick whose interests do I want to serve. And here's what. What's the essence of a hostile takeover? To you as a manager in a target company. What's the message the acquirer is sending? Right after I take over the company, I'm going to fire you. So this makes it upfront and central, right? Do you want to preserve your job, or do you want to maximize stockholder wealth, at least for the moment? Come on. It's human nature. So what are you going to do? You're going to find every way to stop this hostile acquisition. In the 1980s, you had this phenomenon called greenmail. You know what greenmail is? Just like blackmail. It's a lot more money and it's legal. So here's how it works. Somebody's targeted your company in a hostile acquisition. They paid $100 million to buy 5% of the company. You offer them $250 million to go away. You think, what's wrong with that? Well, the $250 million doesn't come out of your bank account. It's just, so basically you stockholder money to prevent somebody from paying a premium on your stock price. Get your mind wrapped around that, because I'm going to claim it's all in your interest that I'm doing this. The reality is greenmail is ultimately protecting managerial interests. Again, you can see why. It's human nature. It's not because they're bad people, but they will find a way to rationalize it. The rationalization might be, that wasn't a high enough price, they're going to ruin the company, etc., etc., etc. The second is a golden parachute. You know what a golden parachute is? You become targeted in a hostile takeover. You run to your lawyers and you put in clauses into your contract after the fact. What do those clauses say? If we're taken over, I get paid $10 million, $15 million, $25 million. When Revlon was targeted in a hostile acquisition, collectively, the managers took 100 million out of the company. You say, why should it affect me as a stockholder? You know who's paying for those golden parachutes, right? You as a stockholder in the target firm indirectly pay for them because the person buying your company now has to knock off that 100 million. Poison pills. One thing about M&A, have you noticed, is this strange mix of medieval times and James Bond imagery. People come on white nights with poison pills. Yeah. What's a poison pill?
Makes the company less attractive.
Generically, it's something you put into the company that makes your company less attractive to acquirers. And you usually add it on after you've been targeted. Okay. Couple examples. The US used to have these strong broadcasting laws that prevented somebody from owning more than 2 TV stations, or you couldn't own 2 TV stations in the same city. So what would happen if you're a broadcasting company that was targeted, you run as quickly as you can to a city where the acquirer had a big TV station. You'd buy a TV station in that city. Then you'd go to the FCC and say, you guys can't let this acquisition go through. Look, it's against the law. It's a poison pill. Or you create these imploding securities that blow up in the acquirer's faces. Classic example is what's called a flip-over rights plan. You know how a rights plan works in a publicly traded company? Let's say each of you is a shareholder in a company. I give you the right to buy an additional share in the company at half the stock price. And because all of you have that right, nobody's hurt by it. That's a traditional rights plan. So let's say the stock price is 10. I give you the right to buy a share at $5. Everybody exercise the right. The share price might drop, but you all end up with more shares. Here's how a flip-over rights plan works. Share price is $10. I give you the right to buy an additional share at $100. You say, why would I want that right? That's as long as I run the company. If my company is acquired in a hostile acquisition, that price goes to $1. You see what I've created? As long as I run this company, this is kind of a benign security. Nobody's going to use it. The minute somebody takes over the company, it kind of blows up. All of a sudden, they thought they bought 51% of the company. You wake up and it's 25% because all these people show up saying, hey, you got to buy the share at $1. Why is it done? For a very simple reason, to keep an acquisition from going through. In fact, the analogy I offer for poison pills, because it's kind of a complicated security, came to me when I took my daughter when she was 8. She's now 20, so it was a long time back. Even younger, she might have been 5 or 6, with her 2 older brothers to brunch. So we go to brunch. They all order eggs with fries. They're all sitting on one side of the table. I'm sitting on the other. No, nobody wants to sit with Dad. So the waitress comes with the eggs with fries, eggs with fries, eggs with... My daughter's sitting in the middle, her 2 older brothers on either side. The waitress puts a plate in front of my daughter, and my daughter spits all over her fries. Disgusting, you're saying, right? But if you have siblings and you've ever eaten fries, you know exactly what she was doing. She was introducing a poison pill. Do you see why it's a poison pill? When you spit on your fries, you're fine with it. It's your own spit. Everybody, we've all done our share of lick sandwiches and put them and take that now. Right? With siblings, we've mastered the poison pill strategy. That's what managers are doing with poison pills. They're spitting on their fries, but they didn't even pay for the fries. I did as a stockholder. So when you see managerial interests dominate, and often when I look at a big news story, I mean, your tendency is to say, let's think of the economic rationale for why the company might be doing it. But half the time, there is no economic rationale from a shareholder's perspective. The reason you're seeing that big decision is because it's in the managerial interest. Company announces that it's moving its headquarters to Vail, Colorado. You know what I read into it? The CEO must like skiing a lot. It's amazing how the headquarters, there's actually studies that show the headquarters of a company actually magically moves towards wherever CEOs like to hang out. Yeah. Again, it's not because CEOs are bad people, but if you don't have a pushback, that's exactly what's going to happen. Let's take the second link. Banks and bondholders lend money to a company and they don't protect themselves. What did I say happens? Nothing. What universe is that? You lend money to a company and you don't protect yourself. It's not a question of whether you're going to get ripped off, it's when you're going to get ripped off. You say, what if it's a reputable company? Big company's been around a long time. That's our defense, right? I offer you the Nabisco example. Let's say it's 1984. You're retired, you moved to Florida. You live on a golf course. You have $500,000 in savings. I'm your broker. You come to me with $500,000 and say, I'd like to invest this money. I suggest a nice mutual fund. I said, too risky. It's my entire life savings. So how about some T-bonds? He said, okay, these were the days when the US Treasury had no default risk, so you feel pretty. But then I tell you what rate you're going to get on these bonds, and he said, too low. So I suggest corporate bonds, and initially you're terrified, corporations. I said, don't worry, this corporation you probably heard of, called RJR Nabisco. I said, oh, I've seen their name all over the grocery store. They've been around like 70 years, right? I said, yes. And not only that, they're AA rated. You have no idea what this even means. But then I tell you, I said, no AA rated company has ever defaulted while it was rated AA. I'm a very careful broker. That's actually technically true. So you fall for it, you take entire $500,000, you buy Nabisco bonds. Then you go off to the golf course. For 4 years you play more golf. And after a round of golf in 1988, you come back, you open up the Wall Street Journal, and there's a headline. It says, KKR does LBO of RJR. Lots of acronyms. You have no idea what it even means. Right? So you call me and say, what happened? I said, nothing technically. But this outfit from New York called KKR has borrowed a ton of money on Nabisco and bought the company and taken it private. Of course you care about, what about my... So technically you still have the same bonds you did yesterday. But remember that AA rating, you're still in the alphabet. But you've slid. AA is now a double B. You say, what does that mean? Well, there's a much bigger chance you will not get paid. He says, I don't understand. What does that still mean? That 500,000 you had in your portfolio, when you check your portfolio tomorrow, it's going to be like 415,000. So you see what happened, right? Same promise coupon, same promise face value, but now that the risk has gone up, the price of the bond on the Nabisco LBO dropped 20% on the day of the LBO. See, this isn't fair. Well, you didn't put in any constraints on a leverage transaction in your bond agreement because it was RJR Nabisco, a reputable company. So I'm going to introduce a word into the lexicon that you're welcome to use. I call this getting Nabiscoed. Anytime you lend money to somebody and you don't protect yourself, you are going to get Nabiscoed. Let's take the third leg. What did I assume about managers? Reveal information honestly and on time. Really? Come on, let's go back. It's human nature, right? How many of you are married? Okay. At least when you left home, you were still married. So hopefully you might not be by the time you get back. You've been gone too long, right? Let's assume you get bad news during the course of a day. Right? Today, let's suppose I get some bad news during the course of the day. I'm not going to be dumb enough that when I get home, open the door, say, I have some bad news. In fact, if I have bad news, I try one of two strategies. One is I try to find a good time. Not now, not now. No, that's the window of opportunity closed. Maybe when she's sleeping, I'll whisper it to her. You're sleeping? I didn't know. So the first strategy is wait for your spouse to be sleeping, whisper the bad news and say, I told you last night. The other is you try to bundle the bad news with some good news, right? Hence the term, I have some good news and I have some bad news. So this morning, while I was driving to the train station, I wrapped the car around a tree. Oh, by the way, I switched to Geico. Completely disproportionate there, but you're hoping that the good news kind of cushions the impact. Companies do this all the time. We lost $3 billion last year, but we're doing really well in Sierra Leone. We've doubled our revenues. The fact that your revenues went from $1 to $2, why even mention that? So the reality is companies do the same thing. So let's say you have bad news come out about your company. You wait for a good time. What's a good time if you're a company? What's the equivalent of your spouse being asleep? When is the market asleep?
Friday night.
Oh, in fact, in fact, I did this early in my life when I actually used to do research, academic research. I used to pick these topics that nobody cared about, spend 4 months of my life, write a paper that nobody read. Right? So this was one of those papers right in the 1980s where I took every earnings and dividend announcement made by US companies, classified them by day of the week to see if in fact the announcements you saw on Mondays were any different from Tuesdays, Wednesdays. So you can see the deep thought that went into this research. Mondays to Thursdays, everything looked pretty much the same. Mostly good news. Then you get to Fridays, the bottom falls out. And then I took a look at what happens on Fridays. Maybe this Friday is a bad day, superstition holds up. And I looked and it's around 4:01, 4:02 on Friday. Terrible things happen to companies. Absolutely awful things. Okay? Of course, the reality is bad things happen through the week. You wait till 4:01, hoping what? That if you have a whale in London who's cost you 8 billion, that by the time people come back on Monday, you're hoping they forget. It never happens, which makes Monday the worst day of the week to invest in. Last 75 years, every single year, worst day of the week to invest in stocks is a Monday. Maybe because of this built-in bad news. So managers tried to massage, whether for better or worse, they tried to control the flow of information in markets. And when markets get that information, do they act rationally and coolly? Let's go back to the trading room that is filled with polite intellectuals and filled with actual traders. Polite and intellectual will be the two words that do not enter the conversation if you're looking at a trading room. Have you ever stood above the trading room and watched when news stories hit? It's like chaos. Buy, sell, do something, we'll talk about it later if we need to. People do some crazy things in response to news. In fact, I'm going to give you a second test you can use. Anytime somebody gets too carried away with a rationality argument, try this out, it works really well. It's called the Elvis Presley test. Okay, let's try it. How many of you think Elvis Presley is still alive? Okay, at least he was on. Right? And he's still in the Triumph program. We're not going to throw him out saying, you're crazy. Okay? Elvis died a long time ago. I'm sorry if you're waiting for the next iTunes song, it's not coming. He died in like 1970. So the second part of the test has nothing to do with you. If you read USA Today, this newspaper, it's a fast food version of a newspaper, which is you can read the whole news in like 12 minutes, the whole paper. And every day USA Today runs a poll. They publish only on weekdays, so this is like 250 questions you have to ask over the course of a year. And so they start asking questions like, do you like lettuce on your burger? 69% of Americans said yes. 23% said no. 8% said I don't know. Have you ever wondered about, no matter what the poll is, there's this floating 7 or 8% that say I don't know. Americans were asked, do you know your name? 93% said yes, 7% said I don't know. So this was in 92, on the 15th anniversary of Elvis's death. USA Today asked this question. Do you think Elvis is still alive? 71% of Americans said no, thank God for small blessings. 22% said yes. I read about it in the National Enquirer, the Daily Star, the Daily Mirror, whatever your source of news is. And 7% of course said I don't know. Let's set the 7% aside as rational and paranoid. The two are not mutually exclusive. And let's take the 22%. Population in the US hit about 300 million. 22% of 300 million is about 66 million people walking around thinking Elvis is still alive. Think about it. Next time you say, look, I'm going to build a valuation model. When new stories come in, people project out the effect on expected cash flows the next 10 years, adjust the discount rate for risk, take the present value, and then do. Are you crazy? There are 66 million people walking around thinking Elvis is still alive. None of this stuff is happening. And that's actually going to be an undercurrent for something we're going to come back to, because we're going to talk about things companies can do which will make their value go up. If you go to this 30% debt ratio, I think your value will go up by 17%. And this is a real company, you know what the manager is going to ask. If I do this, will my stock price go up 17% as well? And my response is, there are 66 million people walking around thinking Elvis is still alive. They affect prices. Okay? I have never felt the urge to defend what other people pay. Know what I mean by that? The day Twitter went public, I valued the company at about $18 prior to its IPO. Stock opened at 45. I get a call from the Wall Street Journal. How do you explain the 45? I don't have to, I didn't pay it. Why would I have to explain something I did not do? Trying to explain what prices do gets you into a huge amount of trouble, because you're trying to put a rational explanation on something that might have nothing to do with rationality. Which brings me to my final thing. What did I say? No social costs, right? But the reality is social costs are always there. Social benefits are always there. This is the area of finance that can get people into a lot of trouble. And it's where I worry about B Corps. I wonder if you're sitting around a table in a B Corp trying to decide how to make an investment, how do you get through the paralysis of dealing with social costs and social benefits? Let me explain. I invest for both my wife and I. Thank God she doesn't check our portfolio too frequently. But I'll tell you the one surefire way of me getting divorced. If I bought Monsanto, it's over. There's no contesting. It'll be done. Because my wife is an environmentalist to the core. To her, so what I'm trying to say is social costs and social benefits are person specific. What you feel strongly about, what I feel strongly about. So when people say, well, I'm going to be socially conscious, whose social consciousness are we talking about here? So the first thing we have to do if we decide to open this door is walk all the way through. Okay? And if you're imposing your social consciousness on everybody else, we have a problem. So if CEOs say, I want my company to be socially conscious, fine. But you are using other people's money. You now have an obligation now to go in front of the stockholder and say, this is my vision for the social consciousness of the company. And I want you to buy into that vision. I have absolutely no problem with you doing it. What I have a problem with is subversive ways in which social consciousness comes in. So what does the CEO do? He says, well, I'm going to give money to the Met. Why? Because I think it's a good cause. Okay, it's a good cause for you, but why are you giving my money? It might not be my cause. So that's, I think, the scary line you get to when you're talking about public companies making those decisions.
But I think that's more about philanthropic money giving away. A
Right.
big hook is you measure the social impact of the company. And you measure
Let's
the
pause right there. When you say social, when you say
Yeah.
measure the social impact, let's be specific. In what?
number of lives saved,
No,
more
okay.
water being given.
Okay, so but already we're starting list. So let's say 5 of us sit around and make those decisions in a B Corp. At least stockholders that came in, bought your shares on that expectation. So that part is out. So they should know that a portion of your money is going to go towards social benefits.
Yeah.
I'm saying now we have to start to get specific. So I'm not saying it's not doable, but I think it has to get past
It's
that.
not about a portion of the money going, it's about the purpose of the business.
But it's the same thing, right? That's
What I
basic.
create
But
and-
it's the same thing as saying a portion of the money. That's essentially how it plays out. Is when you open a store as SD, now let's say you open an online store, you might not base it on how much profit it creates alone, but profits plus 3 other things.
Right.
So you'll have to bring those into the decision process, and I'm saying that's the part of the process where getting specific will help you
Yeah.
make decisions. And the problem SD is facing right now is they've left it too diffuse. And because they've left it diffuse, they're getting pulled in different directions. And once that happens, you can have 6 people, all of whom are socially conscious people.
So it has
But
to be
they-
measured. and-
Exactly. That's exactly right. It has, and that's tough because people don't want to put a number on it, right? They don't want to. But it can be done, and that's I think what I push a B Corp towards is let's start to get more specific. Yeah.
I sincerely don't understand why we're even speaking about this in this context at this lesson. Isn't it a job of the state to calculate what the society
That's
wants,
I think one.
tax accordingly
Okay.
and implement it?
I think that's one extreme view. Is if it's legal, it's legal, right? But I think that there are actions you take, and I'll tell you, as a value person, I think that not everything that's legal is sensible to do. And here's why. If you're running your business as a going concern, there is a value to being viewed as a good corporate citizen. You see what I'm saying? There's a line that you might cross where you're doing things that are legal.
But you take this risk consciously.
You're taking this list consciously, but it might come back. You might be looking at the earnings, the effect of doing this on earnings, but I'm saying you might have to look
Or
at
just
that.
calculate it.
Yeah. And I'll give you an example. A few months ago, the Valiant blow-up happened. You know what Valiant does? A Canadian pharmaceutical company that essentially came out of nowhere to become one of the largest pharmaceutical companies in the world. But in 6 years, it grew from nothing. And essentially, here's the template that they used. Remember I said the pharmaceutical business is becoming a pretty bad business to be in? Rather than doing R&D, they acquired companies. By itself, you're saying that's not a great path. They acquired companies with drugs that had already been approved that they felt were underpriced. And already you're getting to a point where it's getting a little... What does it mean? You have this cancer drug, you have the patent for it, it's selling at $7, but you feel that the people who have the cancer are desperate enough that they will pay $700. So for 6 years, Valiant used that strategy of buying these companies underpriced drugs, pushing up the price of the drug, And then they used, because it's kind of tough to get that through traditional pharmacies, they used an online pharmacy called Philidor to kind of push these drugs to stay. So it's a strategy, you can say, as a corporate finance strategy. Everything they did was legal, and it pushed up their value from 15 billion to 100 billion. Earlier this year, of course, one part of the pillar came apart because people started noticing, of course, as people who have your cancer, you notice your drug price went from 7 to 700. So the first thing that happened, and this was well before the scandal broke, is people started noticing this surge in pricing. Not just 10% increase, but a 100-fold or a 50-fold increase. Okay? And that part of the process got started. In September, this Philidor thing came to the surface when people discovered that the online pharmacies were potentially pushing the limits of the law because they were trying to get these drugs into states that they were not supposed to be in using the online route. And you can guess what happened next. When both of those came to the surface, all of a sudden this strategy that had created value was in the open. People could see it, and it became almost indefensible. The company lost 2/3 of its value. And worse, it can't go back to that old model because now it's under the microscope, which is if you acquire a company with an old drug, because remember, you're negotiating in the US with Medicare and Medicare, which are, so if you are viewed as being corporate, beyond the pale of corporate responsibility, even though it's legal, there can be a pushback. And that's effectively what started happening is once they got noticed, it became more difficult for them to pull their strategy off. Yeah.
Why is it their job to
it's not, but I'm saying,
equal,
but
the government
there's an operating blowback. So even though what they did was legal, the operating blowback now is it becomes more difficult for them to push the drug through the pipeline. It's really an operating effect that is now going to show up in terms of what you can do in the future. So as a pharmaceutical company, you're walking this fine line between doing what's legal but not pushing the limit, because there's a point at which you're going to get a pushback from the government where they might decide to put a price limit on every drug. So it's like the golden goose. You don't want to kill it. You want to keep getting the golden goose that lays the golden egg, whatever, you kind of get it, right? And I think that's the problem you run into. So I would actually, while it's legal, you might actually decide not to do something that's legal because it puts your long-term value at risk. Ultimately, I think it shows up in your value.
Just be aware.
Be restrained. Sometimes it's good to be restrained, even though something might be legal, and not take that extra step. So the reason I'm not going to make a moralistic statement about this, and say it's immoral to raise drug prices, is be very careful. As a company, when you bring up the morality argument, it never ends well. Okay? Charlie Munger, you know who Charlie Munger is? The 92-year-old who co-eds Berkshire. In fact, right after the Valiant thing, talked about it being an immoral thing. And a few weeks later, news story broke about Clayton Homes, which is actually one of the companies that Berkshire Hathaway owns. And the story is about how they were overcharging people in Native American reservations for manufacturing. So holier than thou is never a great strategy to take on as a company because you then become, people are going to keep digging. So I would say that the argument I would make to a company like Valiant is when they say it's legal, why shouldn't I do it? I say in your long-term value interest, you might be better off restraining yourself on that price increase because it actually makes you a more valuable company. And I would leave it at that. I mean, they can choose to kind of go for that extra earnings right now, but your objective is to maximize your value as a company. Yes?
Do you use models like GRI that measure the social, let's say, do you believe in this?
They want you to turn the mic on, so.
Do you believe in models like GRI that measure this type of social
I couldn't throw them. I mean, I wouldn't trust them further than I can throw them. And here's why.
Yeah.
There are 15, 20, 25 different organizations that measure you on social. Take a look at them. None of them match up because each comes with, so for instance, the AFL-CIO has its ranking of 100 best companies, but they look at it through the focus of how well do they deal with unions. So essentially their focus naturally is on their, so if you let Greenpeace rank you, it's going to be entirely based on environment, nothing to do with everything else. And so you can look at 15 of them. They're all going to rank you differently because they bring different agendas. And that's why I would look at them because I think it might affect me, but at the same time, I've got to make this about looking at me as a business and how I fit into this process. Yeah.
Do you think there's any role for companies taking on social vendors?
Is there if it's is it a private business? If it's your money, of course, it's a clean, easy answer, right? If it's your business, like there was this guy in Pennsylvania who every year took 50% of his profits, and he gave it away to for a scholarship.
Not giving away profits, but creating products and providing services that.
But it's the same thing. Ultimately, if you boil it down, right? If you take products and you sell them below cost, or you're selling a product that otherwise could not have stood on its, if it's a product that would have stood on its, say, it's. But it's only, social arguments come in only when something doesn't pass the number. If you pass the numbers test, then the social benefit is really icing on the cake. The real challenge for a company is, and I give this example, let's assume you are the Gap and you tell me you're socially conscious. And let's suppose I came to you with a project where you open a new store in the middle of Newark, New Jersey. Whenever you've been in the downtown Newark, New Jersey, it's a wasteland. And in terms of there are no customers there, it's tough to get employees. And let's suppose I told you, if you open the store, you're going to lose $100,000 every year for the next 25 years. You see what I'm doing? I'm shutting off the easy ways of justifying social costs, which is, if I do this, it'll be good advertising. I can use it in PR. No, let's assume that it's a pure investment. My question is, would you take that investment? And if you would take that investment, how would you explain it to your stockholders? Yeah. And if you don't, then in a sense, you want to be socially conscious, but only if it doesn't cost you money, right? And if that's the case, then it's completely compatible with what we do, which is you take good investments and you look for the investment that provides more social. So it might be a side factor. But I think those aren't the tough choices. The tough choice is, would you make an investment that actually loses you money? Okay? But don't, I mean, as I said, if you did and it's your own business, I have absolutely no problem with you doing that because that's your money. But it becomes tougher with a public company to justify
There are
that.
a lot of businesses that can make a lot of money
Right.
and not lose money through doing social services.
Right.
Unilever, a whole bunch.
Let's take Apple, right? You could say, well, Apple makes a lot of money. Does it make a lot? Of course. Should it pay twice as much as other people do for laborers in people who work in Apple factories? That's where this issue comes in because that, I think, is a trickier, more problematic choice to make. So here's where we're going to start your company. So we're going to look at who runs your company and where the power lies in the company. Okay? Nature, power abhors a vacuum. This is true for politics. It's true. It's also true in companies. The power has to rest somewhere. So what I'm going to do is offer you choices, and then I'll look at my companies, and then we're going to look at your companies to see where the power lies in your company. So here are the choices. You could have a company where outside stockholders actually run the company. Very unusual, but this is a company where the stockholders have it. So that could be. It could be inside stockholders. We're inside stockholders. Yeah, so in the case of Facebook, it's not even management. The case of so management is a separate group. So in the case of Facebook, it'll be Mark Zuckerberg as opposed to you. And in some companies, the divide is actually made explicit by insiders having more voting rights than outsiders, different classes of shares. So it could be a company where inside stockholders run the company. In many family-run companies, you could be a stockholder in Tata Motors, but what you and I think about Tata Motors matters little because a family group runs the company. It could be managers running the company. In some companies where there's enough splintering of stockholding, managers have the power. It could be a company like Petrobras or Vale, where the government is essentially the power behind the throne. It could be employees. In many European companies, you have employees sitting in on the board of directors. It's actually required, so the employees might have. Or it could be lenders. When does that happen? When you get into enough trouble, the lenders might be the ones who make the big decisions because they're afraid of what you will do if they let you make the decision. I'm not sure whether we cross this line at Glencore, but it'd be interesting. Maybe there's a point at Glencore where the banker said, no, you can't make the decisions anymore because it's now my money that's at play. So you ready? I'm going to take my companies through this process, and I'm going to give you a template for doing this in your companies. Right? So let me start with Disney. So this is a very simplistic exercise. What I did was I printed off a list of the 17 biggest stockholders at Disney. Incidentally, you have the 17 stockholders in your company. If you turn to the second page of your Bloomberg packet, you should have a page that looks just like this one. Right? Okay. Or the first page, if you know. If you pulled off the first page, it should be the very first page. It's called the HDS page. In Bloomberg, you type in HDS, no, top 17 stockholders. You say, what do you learn from this? Let's see what I learned from looking at Disney in 2003. I'm terrified after I look at this list. You know what? 16 of the top 17, so see the source 13F? That's a filing by an institutional investor, a mutual fund or a pension fund. 16 of the top 17 stockholders in Disney are big institutional investors. You're saying, so what? What did I say most institutional investors do when they don't like the way a company's run? They sell and move on. Remember what I said, I own 1,000 shares in Disney. I can't make the noise, and these guys don't make noise either. Who the heck is going to make any noise in this company? This is a company in 2003 where managers essentially had room to do whatever they want. We'll come back and look at how things changed in 2009 and 2013. But that's 2003 Disney. This is a classic separation between stockholders and managers. It's a managerial run company. 30% of all large market cap companies in the world look like Disney. 30%. 1 out of 3 companies or managers are, they essentially run the company. It's a managerial company.
If it was, if the stakeholding was highest, say, with the promoter.
We'll talk about that. We'll come back to that. That's going to be another case. It's not the case in Disney. The notion of a promoter, you know what a promoter is in India? The founder is usually called the promoter. Okay? And early in a lifetime, usually founders have power in companies. In India, promoters kind of hang in there long past their due date. They continue to have power. We'll talk about how they continue to have power in those companies. Often, even though their shareholding might drop off, the way the market is structured, you can, as a promoter of a company, or the son of a promoter, the grandson or the great-great-great-grandson of a promoter, end up still running the company with 3% of the company. Okay. Not the case with Disney, but we'll come back to that. Here's my second case. I took a look at Vale. Yeah.
Why doesn't it show individual investors? I know in that Disney.
Yeah.
For example, in mine, I know the owners of this company, and they are not.
What company do you have? Do they have 2 classes of shares?
Okay.
And that's in fact my second point. You know when you are in corporate governance trouble is when you look at your company and you see 2 classes of shares. I hate to be cynical, but when you have 2 classes of shares with different voting rights, and you and I buy shares, guess which one we get? One with the low voting rights. A cynical view, but when you have 2 classes of shares, there is only one reason for that, which is that the founder, promoter wants to preserve control.
How do you find it?
You will see in your company, if it says Class A or Class B after the shares, then you order. So if you have 2 classes of shares, usually you see a Class A class. If you don't see an A or a B next to your shares, you have only 1 class of shares. Okay? So let's look at Vale. 2 classes of shares. In fact, in Brazil, this is the rule rather than the exception. The shares are called common shares and preferred shares, but don't be thrown off by the nomenclature. Common shares are shares with voting rights. Preferred shares are shares without voting rights. They're called preferred. Why? Because you don't get voting rights. It's a very, very Orwellian view of the world. You get a dividend up front, but it's preferred shares. So already you know you're in trouble because you're common and preferred shares. Yes?
What's the point with the institutional investors?
That's a good question. So why do we invest in these companies? That's a different, it's almost a psychological question. It's why we invest our money in a company which really doesn't care about what we think. But lots of people do. 2/3 of the world. You have 2 classes of shares. So Vale is 2 classes of shares. The non-voting shares are held by all kinds of people. So if you look at the listing for non-voting shares, it has all the institutional investors, but they don't have any power. In this case, they have no voting rights. The voting shares in Vale are held by 6 entities. And one of the biggest holders of Vale shares, in addition to this Lizio Participo, is BNDES, which is the Brazilian national. So it's controlled by the government. So basically, the voting shares are controlled by a small group of entities, one of whom happens to be the government. So already you can see the government's role kind of kick into play. But to add to the government's role, the Brazilian government also has what's called a golden share in Vale. You know what a golden share is? Margaret Thatcher actually created this when she privatized UK companies. Golden share allows the government veto power Over what? Big decisions like acquisitions, big investments in other countries. So file that away. This is a publicly traded company. You own shares, but you have preferred shares. The common shares are held by a small group of entities, one of whom happens to be the government. The government adds to its power with the golden share. So what do I learn by looking at Vale? As a stockholder, not only will I have little power, but much of what Vale does is going to be in serving government interests. If the government interests and mine converge, yay for me. If the government interests and mine diverge, I'm screwed. And I know it. There's not much I can do. Okay? Let's take the third case. I looked at Tata Motors. Incidentally, in India, you're not allowed to have two classes of shares, which is good policy. So I looked at the largest stockholders in Tata. And as you look down the list, notice there are a lot of Tatas on the list. Other Tata companies are 7 of the 17 top biggest stockholders in Tata Motors are other Tata companies. This is a cross-holding culture. It's actually common across Asia, Latin America, and parts of Europe. Spain, for instance, this is the par for the course. What does it accomplish? It basically means that when you have voting, you're going to get other Tata companies voting the family's interests. Right? So let's say you push it, you want Tata Motors to change the way it's run. You put it up to an annual meeting vote, all the Tata family companies will vote with the management. Yeah.
In this, will we have to see the holding in those companies?
You could, but I'll tell you what, you go and say, you know who the biggest holders in these companies are? Tata Motors. So it's essentially like solving a simultaneous equation. And the reality is, don't even go there. You know in these companies, the family group. So why go looking for trouble? Ultimately, you've already nailed down the culprit. The power is with the family. Let it go. There's a karmic moment in corporate finance and valuation where you say, look, that's the way it is. I either take that. That's the rule of the game. I can't change those rules. Yes? Why is Citibank? Because Citibank is actually a custodian for somebody's shares. My guess is Citibank is not the holder. What company are you doing? Oh, you're telling me why is Citibank the biggest holder? It's actually, in this case, because Indian investors are remarkably cagey about hiding behind custodians. So, and actually in many Indian companies, you see the top 17 stockholders, what you see is not what's back there, right? It's actually a problem of transparency. It's a problem of opaque reporting, and that's basically, so it's not like Citi is a large stockholder in Tata Motors. They're holding shares for somebody who doesn't want to be revealed. And my guess is it's somebody in the Tata group. So, and often with promoters, you often won't see the promoter's name in the top 17 because they've used these disguises. Reliance, Ambanis don't show up in the top 17. We all know that the Ambanis own Reliance, but they figured out ways with these names you can't even recognize, but they hide behind these names. Yes?
So I don't want to distract with individual cases, but on Unilever, I note that the People's Republic of China is a massive shareholder.
Yeah.
How would one interpret another government owning shares?
I'll give you the benign case. Heard of Temasek? What does Temasek do? It's a Singapore sovereign fund. It's a remarkably professionally run fund. If Temasek is on your portfolio, you know what they're watching out for? They're watching out for, do you make returns for me? That's all they care about. Because the Singapore government does not step in and say, well, our interest. China, all bets are off. In the case of Unilever, my guess is for the moment it's benign. You know when it might show up? If Unilever decides to pull a big investment out of it. Let's say in the crisis, Unilever says, look, we've got to get out of China. This is too dangerous. That's when sovereign funds can potentially be problematic. And that's actually a good point. What I'm trying to argue for here is you want to be aware of conflicts of interest that exist below the surface. Because right now they might be benign. But if they exist, there will be somewhere in this corporate financial analysis where they rise up to the surface. So it's good to notice things like saying, hey, you know what, the Saudi sovereign fund is my largest stockholder. What does that mean for me as an investor in this company? And think through the consequences, often of not so benign cases. The People's Republic of China, there will be probably times where your decision making is going to be skewed by the fact that your largest stockholder is a sovereign.
just help us understand what the source is?
Yeah.
How do we go?
It really, see, the way Bloomberg comes up with this, it pulls this from public information. So in the US, that's SEC filings. The 13F, for instance, is an SEC filing. With India, it's company filing. So depending on where your company is incorporated, the place where Bloomberg, it's actually miraculous that it's able to pull these things together because it's coming from lots of public sources. But you also can tell that in some parts of the world, you should not trust this listing, right? Like in Russia, if you tell me who the top 17 stockholder, I'm going to look at it and say, nice, but
So one
it's,
stockholder.
yeah, it could be one stockholder. So in a sense, it reflects the quality of the information in different parts of the world. So they're not all equally trustworthy or non-trustworthy. It depends on what part of the world you're looking at. Yes?
If the company itself is one of the large shareholders,
Yeah, we'll come back to that. I'm going to look at one of the scenarios because this is a strange scenario. The company itself it's the largest stockholder in itself. China Mobile is the largest stockholder in China Mobile. You say, what the heck does that mean? They've set up a corporate holding structure where, you know, you worry about in a takeover that somebody will take over your company. Okay? Have you ever seen shell games on New York City streets? Shell games are when you walk down the street and the guy says, come on over, you can win $20. And it's a shell game as he moves these shells around. Under one of the shells is something, and if you can tell which shell it is, you win money. Some companies play the shell game really well. They have 6 corporate entities. Royal Dutch used to be a master at this. 6 of them, 5 were shell, and 1 was a real company. So you tried to do an acquisition of Royal Dutch, they'll wait till you spend $100 and say, hey, you bought the shell. Sorry, you're over there. So you go run over there. So it's control. It's control that drives these kind of very contrived setups where you get this separation between the company and the holding company, all have the same name. So it can happen. Yeah.
In this situation where you have a majority shareholder, what's your thoughts on whether the family in this case is actively involved in management or is more hands-off?
You've answered the question. Do you think they have families actively involved in the management of the company? Yeah.
Yes.
Family group companies, you can almost take it as a given, right?
Take the Clutton family in BMW, for example.
That's it. I think the further away you get from the founder, the less involvement there is. So that's a good point, is as you get further and further away, the less involvement there is, especially in Europe and in North America. That's not true in Asia and Latin America. You often find that even if you get 100 years after the founding, that's a promoter story, where the promoter thinks that he's entitled to run the company, not just through his lifetime, but through his, so it's almost like they're not family-owned companies, they're family-run companies, right? But they figured out a structure where it's almost impossible for the outsiders to kind of enter it.
What's out of this? What do we try? What is better? What is?
There is no better or worse. It's reality. Basically, what I'm saying is face up to the reality of whatever your company is, and be ready for what's going to come out of that structure. So when we look at how Vale behaves, we say, well, that's strange. Why would they do that? You know what I want you to think about? The government is the largest stockholder. So something that makes no sense from a corporate finance standpoint might make complete sense once you bring that in. So what it's going to allow us to do is see what companies do and make sense of them given who's running the company. Yes?
how do you find information about golden shares?
You have to go into the companies. The way I found it for Vale is they actually, as part of if you go to the financial statements, there's actually a statement about the shareholders, and one of the things they mentioned is the golden share. Right? So yeah, I had to dig, but not too far, too deep to get to that. Right? They're very unusual. You know, when you'll find them only in companies that used to be government owned that have been privatized. So you don't have to look for golden shares. We look at Unilever. You're going to find them at a old power company, which used to be a government company 30 years ago. So it's almost always going to show up in the context of privatizations. One final company, Baidu. Right? Here I didn't even dig to see whether I had power. What did I say about Baidu? You're buying a Cayman Islands shell company. You have absolutely no power in how this company is run. Is that bad? Is that good? Well, it's what it is. I would not invest in the company for that reason, because to me, if you want my money, I want you to have my input as well. But in the case of Baidu, the reality is that's how it's structured. Yeah.
If the underlying company was, for example, a UK company, an American company, you can establish a mechanism of translating decisions. But the problem is that the underlying company is a Chinese company, and how do you translate
It's not just
decisions?
that the agreement itself is technically illegal. That really is the problem, right?
Yeah.
So you're trusting lots of different things. You're trusting the shell company, you're trusting the legal agreement, you're trusting the operating company. You know when it'll come to the surface? When you have a real problem with the operating company. It's happened dozens of times with Chinese companies with this structure, is it comes to the surface when there's a crisis and you try to make changes and they tell you to sue in Chinese court. Well, good luck to you there, right? This is a company, and this is exactly why when I valued Alibaba at the time of the IPO, I gave it a $161 billion value as a company, the highest number I've ever given to an IPO at the time of its public offering. And I was on CNBC that day and they asked me, would you buy Alibaba? And I said, you know what, Jack Ma is charging me 5-star hotel prices and make me stay in the outhouse. Because he's collecting my money, saying, pay me out, you know, this $160 billion for equity, and after he's collected the money, he says, go away. That cuts me for me, that doesn't work. But you might be okay with it at the right price. You say, well, I'll buy Alibaba. But that's why we need to be aware of what's coming. And let me close this process by showing you what Disney looked like in 2009. Who's the largest single stockholder in Disney in 2009? How the heck did Steve Jobs become the largest stockholder in Disney? Because when he sold Pixar, Disney paid with shares. A little later, I'm going to show you the 2013. And you can see other names starting to pop up. But I'll make a confession. As a Disney stockholder, and I've been a long-term Disney stockholder, I felt a little more comfortable in 2009 rather than in 2003. You know why? It's not that Steve Jobs goes to sleep at night saying, I wonder what Damodaran wants at Disney. What's the biggest problem in entertainment businesses right now? One of the biggest problems I see is the business is changing and the companies don't seem to realize the business is changing. In what way? Netflix and Amazon are changing the nature of the entertainment business. The status quo is too attractive. And whatever your critique of Steve Jobs might be, one thing you could have never accused him of being is being a get along and go along kind of guy. I am glad I was glad when he was the largest stockholder in 2009, because if nothing else, if Disney kept saying the same thing over and over again, I was convinced he'd said, that's not working anymore. Of such small changes is hope born. Sometimes all you need is a change in the list and somebody popping up on that list. And it's not you that's creating the trouble. And that's why I said we need the Carl Icahns and Bill Ackmans of the world. It's not that what they say is right. Carl Icahn is not the deepest thinker on the face of the earth. In fact, a standard pitch is, he goes to a company and says, you have too much cash, give me the cash. Pretty much every Icahn pitch. But having him on that list of top 17 stockholders means that at least somebody is asking questions of managers, forcing them to explain what they do. And that to me is a good thing, because this is about accountability in public companies, and in many companies, managers don't seem to have to explain to anybody what they do. So when we come back from the break, what we're going to start with is we're going to take a quick look at your company's top 17. And I'm going to give you a very simple template of different companies and different parts, and you can look at where your company falls by looking at that. So let's take a lunch break, and we will